Hello and welcome to another episode of the Smaulgld Subscribers Sound Off. Today we have with us a new guest, but many of you know him already from the SRS ROCCO report. We have Steve St. Angelo with us on the line. Steve, how are you doing today?
Great, Louis. Good to be here and a lot to talk about, so I'm looking forward to the conversation.
All right, excellent. Well, for those of our listeners who are not familiar with your work, Steve, can you give us a background? And I want to cover a lot of things here, so if you got a long answer, it's a long answer, would be great. When you started covering the precious metals, what prompted you to start covering them? And perhaps what theories you subscribe to now that you didn't subscribe to when you started, and vice versa. So take it away, Steve. Tell us about SRS, the SRS ROCCO report.
Okay, well, great. Thanks, Louis. Yeah, this goes all the way back to 2002. Years ago, I've always known something was kind of wrong with the markets. And so I started researching about silver, the precious metals, late 1990s, early 2000. Then I started reading about Ted Butler's work and seeing that at some point in time in the future, silver was going to behave kind of like rhodium, where it went up to 10,000 because of supply and demand fundamentals for the industry. And I got interested not only in silver as a store of wealth investment, but also the supply and demand fundamentals. And it wasn't, I started purchasing my first ounce, I think it was in 2002. I think I purchased my first ounce for $4.85. And I continued to acquire precious metals and doing more research. And then I didn't really start writing articles until about 2008. And that's when I got interested in doing more analysis. And then I started my blog, Louis, in 2013. And then I became very interested in energy, peak energy, peak silver. And the more I read about the energy, the more I realized the energy was the #1 driver of everything in the market. And most people don't understand that. Unfortunately, the analysts today, the market looks at energy like oil, natural gas, coal. They look at energy like the housing market or the automobile industry or the retail sector. It isn't. Without the energy, you don't have any sectors. Energy drives everything. And so the more I read about energy, about so-called peak oil, then I found out about the energy return on investment, and as well as now the thermodynamics of oil depletion. And this was a major driver now of my research. So in the beginning, I was very interested in the metals, precious metals, because of their the debt, all the derivatives in the market, the fiat money. It just, I knew over time it wasn't going to continue forever, just like what's happening in Venezuela. But then as I understood about energy, I realized that the energy was the more important factor to understand. And so now, even though I write a lot about precious metals, I focus how energy impacts everything, whether it's the economy, whether it's mining, whether it's the debt, because I do believe all the problems we're seeing is a result to this falling energy return on investment, as well as the thermodynamics. And on my website, I talk about that, discuss that, and I do believe we're going to have serious trouble in the future, and it's all due to energy.
Well, can you give our listeners a kind of a summary of how energy relates to debt? Because aren't a lot of energy sources reliant on debt, and debt that they can't necessarily pay back through the production and sale of energy? Am I getting that right?
Yeah, you see, years ago, when we first started tapping into oil in a large way, in a big way, like let's say in the 1930s, we were tapping into oil wells, oil fields that had energy return on investment of 100 to 1. That means the energy that was used to drill and produce that oil, 1 barrel worth of energy, it would produce 100 barrels of oil to the market. And it was just very easy. We remember all the huge geysers. There was one in California, the Lakeview geyser. That thing it flowed unrestricted. They couldn't stop it for like 6 months. They estimate the energy return on investment of the Lakeview geyser in the 1910, I believe it was 30,000 to 1. Now, over time, you go through all the easy to get wells, oil wells, and then you have to start producing, you have to start using more energy. And now, shale oil, Lewis, the amount of trucks, the amount of energy, the sand, the water, the fracking fluids, it's well below 5 to 1 now. And so the issue is you need more debt now to produce the same energy. Before, you had a very big gain. Not only did you have a positive, very high energy return on investment, you also had a very high return on investment. Now, what's interesting, what people don't get, a lot of the oil in the United States was produced by wildcatters. And wildcatters, especially in Texas, Oklahoma, Louisiana, what they did was they used, like the Hunt brothers. Remember the Hunt brothers, the bunker hunt, they cornered the silver market. They were big oil men. And they funded a lot of oil projects. So it was done privately. And so if you screwed over the Hunt brothers, you did it face to face. If the oil well was dry or that you were doing a lousy job. Today, most of the oil is produced public companies. So what they do is they take investor money from investors they don't see. And so that's the whole different ball game today. So unfortunately, yes, there's a lot more debt today because the energy is so expensive. It's actually, I hate to say this, the U.S. oil industry has burned through almost $250 billion more than they made in operations since they started producing shale oil and gas in 2007. And the investor is holding the bag.
Okay, now let me add to that. So it's less profitable and perhaps even not profitable to produce more oil, and then it takes more oil in order to do other mining. So in other words, to get silver, the low-hanging fruit is also gone. It takes more energy. It takes more energy to get gold. And your average cost per ounce of pulling those metals out of the ground, that's also now more expensive. So here's my question. If that were the case, and we have eventually declining or at least stabilizing gold and silver production, you would think that that would start to influence the price, because obviously you'd have less supply coming onto market and you'd have somewhat consistent demand. What do you make of that? Is that something that eventually the supply demand dynamic will eventually break and you'll just have to see higher prices because the miners can't afford to produce new silver, new gold at these prices?
See, that's a good question, and we could actually discuss that for an hour. But to put it in a nutshell, I used to believe in the Austrian school of economics theory on supply and demand. And supply and demand is a driver of price. But you have to think of it this way. Cost of production is the leading indicator, the major indicator of the price of a good, service, commodity, or energy, or metal. So if you go, let's say go 100 years, and you look at the price of gold, what it cost to produce in 1900, and then you have a graph of what it cost to produce gold over, a price of gold, the market price of gold. Now, if you look at that market price of gold, it's the cost of production is the overwhelming factor. Now, when there's more demand than supply, it pulls the price above the cost of production. When there's less demand and there's more supply, then it goes below a bit the cost of production. And it's more true with commodities and like oil than it is with gold. Gold, as I've seen in the last 20 years, the price of gold has remained above the major companies' cost of production, Barrick, Newmont, Goldcorp. And so the thing is, if you understand that it's the cost of production now, then what does supply and demand matter? Well, this is how it matters. And then the problem is the world has invested its funds into stocks, bonds, and real estate. And so if just a fraction of that money had gone into gold and silver, we would see different prices. And so the problem is it's not really supply and demand. because we know like a stock like Bear Stearns can go from $90 one day and in a few weeks could go to zero. We see gold and silver really can never do that, but stocks can. Real estate prices can collapse. Bonds can go worthless, but gold and silver can't. So I think the issue is it's going to be a supply and demand thing going forward for the precious metals, but it's going to be let's say this disintegration of the U.S. shale oil industry and as well as the global oil industry, which is going to impact the value of most assets in a negative way. And that's when I see the price of gold and silver moving higher. It would be with demand. There would be a lot more demand because there's not many safe havens, but it's more due to the implications of the energy than it is to supply and demand.
Okay, let me throw two more variables at you. We all know that to whatever degree we think about it, that there is some level or total control over the price of gold and silver through manipulation. We don't need to go into how they do it, but we can talk about naked short selling and so on. Now, that's one way where they manipulate the price, which has an impact on the supply and demand. But the second thing that they do, it seems to me, is they can manipulate the supply of gold and silver, and not because they have a magic wand, but because they can actually move people into what you would call a safe haven, into ETFs, COMEX futures contracts, and other digital sources of gold and silver. So how do you factor in that the supply of gold and silver, what people think is gold and silver, is actually multiples larger than the actual physical supply? Because I saw today that at World Gold Council saying that ETF sales are increasing. In fact, the World Gold Council is going to sponsor a new ETF, and people seem to be trusting a digital asset. And we were talking about in the pre-call, the U.S. Mint sales, the physical sales of gold and silver have become almost non-existent, especially gold, in the past 6 to 8 months. How do you factor in that supply issue when they've managed to somehow dissuade people to want the physical metal, meaning that the supply now is not strained because there's fewer people, fewer ounces being sold that way, and then they're satisfying whatever demand there is for a safe haven by selling them digital paper, gold, and ETFs and products of that nature? How does that factor into what eventually is going to happen? Do you see there becomes a point where people decide, basta, I don't want this ETF because it's not available to trade on the weekends, I can't get my gold? Or do you think people are oblivious to that because those sales keep going higher, but the physical sales keep going lower? People too trusting in the digital system?
Yeah, that's an excellent question. And I think there are two markets. But before I get into the two markets, let's talk about the supposed manipulation. There is manipulation, but it's kind of like what the chiropractors do. Chiropractors manipulate the body. So the body functions, the bones and the muscles and the nervous system functions correctly if it's out of whack. Now, what the central banks are doing are manipulating the system for the benefit of the whole. Even though that sounds crazy, they really are. Because in 2008, if they didn't step in, it could have been very bad. It would have been very bad. And I disagree with Peter Schiff that if we let the banks go under, then we can start over. We can't. We don't have the high energy return on investment. It would be like, it could be very ugly. It could be a depression that we'd never get out of. So the thing is, if we understand that the price of gold does not go below its cost of production, they can only manipulate it so low. What they're doing, Lewis, is they're manipulating it from rising too high. Because a high rising gold price, all of a sudden it behaves like Bitcoin. When no one cared about Bitcoin except for a few techies when it was trading a few bucks or $100. But when it started going up $1,000 a day, then people woke up.
Yes,
that's right. They chase it. So to keep gold off the radar, they cap it. I believe they do that. But they don't cap it below its cost of production, because then traders would come in, know it's a great deal, and buy it up. So that's all they're doing. Now, the two different markets I'm talking about, there is the physical market, which is the 1% or less buyers. They're still there, but they're just not buying. They're just not buying. And that's more of the small buyer. Because I spoke to a precious metal dealer, and in 2007 to 2009, the 65% of the buying came from the small buyer. Now it's switched. 70 to 75% in 2018 of precious metal buying comes from the large 50,000 or more. So the small buyer has given up. But now the ETFs, that's retail investment. And we had two spikes in gold retail investment in the first quarter of 2009 when the markets were crashing. We had record gold ETF lows, and then we also had it in the first quarter of 2016. Now, I believe the reason why we had an uptick in the first quarter this year was due to the market sell-off. It panicked people, but it didn't panic them that much. So I do believe, Lewis, there's two things going on. The precious metal, let's say, enthusiasts have really cut back on purchasing physical metals because the ETF purchases really never did purchase physical. They never have. Not in 2009, not in 2016, and they're not really purchasing it now. But when the markets really do roll over, I think starting at the end or the fall this year, we could start seeing a lot of increase in ETF buying. But it won't be until the gold and silver prices start to really take off. And I think that will happen when the markets really crack. Then we will see the 1%, 0.5% of physical buying return, and we won't see it until that point.
You know, one of the things I noticed as I track the monthly sales of American Gold Eagles, American Silver Eagles, Canadian, all the sovereign mints, I went back the other day and I looked over the past 3 or 4 years. It's when there is volatility in the price of silver, and especially silver and gold, that you see the largest amounts of purchases. So that could mean when the prices were dropping rapidly in 2013, 14, and 15, you had heavy buying. And when they were rising rapidly also in 2010 and 11, you had a lot of silver buying. The past 12, 14 months, especially silver, hasn't really gone up or down very much. And this year, it's been pretty much flat, sitting around. It hasn't really gone up or down more than $1. And that seems to also be influencing the purchasing of silver. But let's talk about now China and India. I know you're familiar with the demands there. That demand has not really slowed down in any way, shape, or form. 2015 was a record year for silver in India, a record year in gold for imports. They've fell off in 2016, 17, have come back at the end of 2017 and 18. China has continued, that was India, China has continued to have massive amounts of gold flowing into Hong Kong. The Shanghai Gold Exchange, I just looked at the April numbers, through April are the second biggest year for withdrawals on the Shanghai Gold Exchange. So there is physical demand in the two largest consumers of physical, and that's China and India. But they don't seem to influence the price because in those record years of 2015, they were merely taking advantage of the lowest prices. They were the bottom. 2015 were the recent bottoms in the prices of gold and silver. And then it seems if the price starts to tick up, like you saw when you were mentioning those peaks in ETF flows, simultaneously, that's when you see India and China slam on the brakes for their gold demand. They don't want to pay too much. So how do you factor in China and India into your overall supply-demand analysis?
Yeah, I think it's a difference of ideology, Lewis. The Indians are different even than the Chinese. The Indian traders, they purchase silver a lot more than China. There's not much demand for silver in China. There are for traders, but the public doesn't really care about silver. They care about gold.
That's correct.
Now, the Indian people do purchase silver jewelry, but more gold, a lot more gold. But they have a lot of demand for trade. The traders use silver for trading, and so they can purchase, as you know, a lot of silver. They can import a lot of silver. So they're also very. If you go to a market and haggle. The Indians are very good at haggling. So when they see a price that's too high, they're not going to pay for it. When they see a very low price, they're going to load up the truck. So the difference with the Americans or the West, let's say Canadians, the United States, Westerners, they accumulate because we accumulate in the West more for economic or financial collapse, where the Indians are trading silver more for trade, and the Chinese are doing the same thing with gold, but they're also accumulating it as well. So there's a lot of different dynamics going on, and it is quite interesting. Yes, even though silver has fallen off demand in India, it's really fallen off in the United States and in the Western. It's funny. It's mostly bar demand, investment bar demand in India, but it's coin, mostly coin demand in the United States. And so it is going to be interesting to see how much India is going to import. And I think you just did an article on it. They had a pretty good amount in January, February so far this year, correct?
Yes, India is the silver demand has increased this year and has been increasing throughout 2017 and 2018. It's the gold demand that's starting to fall off this year, but still, both silver and gold, they import prodigious amounts. One, because they have no domestic gold mining supply, and they have very little silver mining supply, so they have to import their amounts. And as you mentioned, Indians they like silver, not the way they like gold, but they do buy bars, they do buy lots of jewelry, large middle class. I think their middle class is larger in population than the entire population of the United States. So people with money, when silver's cheap, you buy a bracelet for $20, $30. They can afford that. They may not be buying gold with it. But China is the real wild card because, like you say, they really like their gold, and they produce like 450 tons, world-leading production, and none of that leaves China. And then they import massive amounts from around the world through Hong Kong, Shanghai, and that gold stays in there, and it gets traded amongst themselves on the Shanghai Gold Exchange. But let's move over to other sources of demand for silver, because a lot of people are focused on the investment side, but historically, as you know, that silver has been anywhere between 55 and 80% industrial use, and it used to be the large portion of silver was used in photography, and that's been replaced now. That's gone away, but the industrial demand remains because it's been picked up by electronics and by solar. Where do you see solar impacting, if you think it would, the overall supply-demand dynamic? From what you're reading, what you're researching, do you see, and this is part of your energy thesis, do you see solar energy becoming such that there is a great demand for it, that somehow it becomes economically feasible, there's a return on investment, and therefore it makes sense to really ramp up the solar production, and therefore require more silver? Because I think right now silver demand per year is under 100 million ounces of the 800 and so million ounces mined. Do you see that potentially doubling or tripling, or do you think if it were to, that much demand were to be required, that they would find other sources? Or do you think that solar demand will never really gain that type of acceptance because it's not efficient?
I totally agree with your latter comment. The Charles Hall and Pedro Prieto did a book. They wrote a book. They did a study on the Spanish solar industry. Now we have to remember, even though Germany has added a lot of solar, probably the most solar in Europe, they are more north of the equator, so they don't get as much impact from the sun as does Spain, which is closer to the equator. So a better study on how solar functions as an industry. Now I'm talking about one home as an industry is studying Spain. They did an energy return on investment study on the Spanish solar industry, and gave it a 2.4 to 1 energy return on investment. And we know that the shale industry is 5 to 1 or less, and it isn't making money. A lot of the solar companies in Spain went bankrupt. The problem is solar doesn't pay for itself over its life expectancy. It just doesn't. And so I'm not saying it's not wise to have solar on your home for guaranteed power. That's wise. But to as an investment, as an energy return on investment, it will not scale. It will not, or will wind.
Well,
So
excuse me,
even
then
though,
if it were to scale, then it would run up against the problem that if as it scaled, it would be running up against a price of silver that would prevent it from scaling, because if they were eating up that much silver, then the price would rise and they'd have to look for alternatives, and then you basically would have a wash, because if it was scaling on the economics, the amount of silver that they might need might cause it to become uneconomic.
I mean, that's true. That's true. And the amount of silver that goes into a whole solar array is it's not a lot.
And it's becoming becoming less. That's right. They're figuring out ways to use nanoparticles. Right.
But I think here's the issue. Even the United States solar installations last year fell 30%, but they were very high in 2016. But the problem is, I see where we're heading, Lewis. I think where we're heading in the next few years is a major deflation, a market correction. And so at that point in time, and that's going to impact the oil price. The only reason solar takes off is if energy prices like oil, natural gas, coal go through the roof, because then it's more supposedly affordable or makes more economic sense to get solar or wind. But when the oil prices fall, then it pulls the rug out from that kind of notion that these renewables are helpful.
All right, let's talk about. I want to know about oil, because I don't study it very much, and I know you pay very close attention to it. What are the factors right now that tell you that oil is either going to go way up or way down over the next 5-10 years?
Okay, if you're asking me 5 months, I couldn't tell you. In the beginning of the year, I thought we would see the oil price peak and decline. I'm not saying it would continue to go down, but if we look at the commitment of traders and we look at the oil sentiment, in 2014, when oil was 105, the commercials, which we talk about gold and silver, they control the gold and silver price. The commercials had 500,000 net short positions. Now, over the next year and a half, by 2016, oil fell to 30. The commercial short position fell to 180,000 contracts. Today, it's at a near record high of 720,000 contracts. Now, the high was like 740, but it's only 20,000 below the high. When you look at that, at some point in time, those commercials are the ones that are going to liquidate, and they don't cover when the price goes higher. That's the longs, the speculative longs. So when you see the commercials holding 720,000 net short positions, when you see the stock market severely overvalued, when you look at the lumber price, which is
that's unbelievable. What's happened? It's tripled in the last 3 years.
Yes, and then so when you start looking at all the supposed unemployment is at a low, when you look at the typical government indicators, when you start putting all this together, for people to think we're going to have a continuation of what's been happening for the next 5-10 years, no. I see a big deflation coming, and I see the markets correcting severely, probably starting at the fall of this year. But again, there's no guarantee, but a fall is a good time.
But when you have that, though, what happens to the price of oil?
It goes down. Now, the oil price always goes down with the market. Oh, it always has. Now, in 2008, it behaved a little different.
Well, hold on.
I don't know if it'll happen.
During the stagflation, well, I guess that was inflation. So you had rising prices and you had rising oil prices. That's right. Okay. So
yeah, now doing a market correction or let's say a deflationary period, everything goes down. Real estate, stock and oil.
And how do gold and silver do?
Well, I believe this time around, and even Charles Nenner, who I've been following for years, but I totally agree with his setup for the next 2-3 years. Real estate prices are going to fall. The stock market is severely overvalued. It's going to fall. Commodities are going to fall. Energy is going to fall. Oil stocks are going to fall. Everything is going to fall. And even bonds are in trouble because a lot of people are in bond funds, not bonds as in treasuries. And that's a whole different animal than let's say a treasury. But I believe after this summer, the place to be will be in gold and silver. And amazingly, gold and silver go up even more during a deflation than an inflation, even though they do go up during inflationary periods. But this time is different for gold and silver, and that's due to the energy. That's due to the whole setup of the market. But getting back to what you said, the oil price is going to roll over. And unfortunately, the shale industry now needs a very high oil price, not just to remain profitable, but just to be able to service the interest on its debt. The U.S. shale industry is a Ponzi scheme. They continue to, let's say, issue $1 billion. Companies do it all the time. Issue $1 billion in new senior notes that aren't due until 2025. They take that $1 billion and they pay off the notes that are due this or next year. Because why? They're not making the money to pay back the debt. So the debt continues to increase. It's over $250 billion now. Most of that will never be repaid. So that's the definition of a Ponzi scheme. Now, if that shale industry works, if the oil price remains kind of high where it is now, it works. It kind of treads water, but it falls apart if the oil price goes under $50 to $45. But again, I don't see the oil price. The oil price could, Lewis, it could go up like it did in 2000. I was amazed. I went back and looked at the charts. The price of oil continued to increase in 2007 and even in 2008 while the markets were rolling over.
So let me ask you then, do you think that the oil market may be or could possibly be manipulated in order to maintain a price for the shale oil producers to try to pay back their debt? And do you think it's like a strategic asset that perhaps the Exchange Stabilization Fund is involved on the other side, trying to make sure that the prices are kept higher?
Well, let me tell you, it's in everybody's interest. It's just not the United States. It's in Saudi's interest.
Of course.
It's in Iran's interest. So it's in Russia's interest. It's in,
all large oil producers.
When I see all these geopolitical things going on, you wonder, is it due because the oil price, the oil price is allowing oil production to remain high.
Correct.
And so if oil prices fall, it will pull the whole economy and financial system down with it. And so here's the difference too. People say, well, what's the difference today than 2008? Well, in 2008, we had the collapse of the housing market. We had the collapse of the investment banking industry. It looked really bad. But Lewis, in 2007 and 2008, the U.S. oil industry was in pretty good shape. They didn't have the debt.
It was a lot smaller.
Let's say there were a lot less shale companies.
Yes.
Now we have all these shale companies. They've borrowed all this money and they're in debt up to their eyeballs. And I mean, some are paying a quarter of $1 billion a year just to service their debt. And so this is now the next market, let's say crash or next market correction. We can't tap into all more this debt in this shale oil. We did that already. That card has been played. So this time around, the energy is going to be in big trouble too. So it's going to pull the whole system down with it. So my analysis, I believe we're going to see a much lower oil price over the next two to 3 years. It's going to take 2 to 3 years. It could happen sooner. When that happens, it's going to pull the rug out of the U.S. shale oil industry.
Okay. What now does that, as we've seen, basically since 1987, whenever there's a financial issue, crisis, stock market, whatever it is, the United States, other central banks have, starting with Greenspan, we stand ready, willing, and able to provide liquidity. We've seen they've gone well past providing liquidity. We see they'll buy equities, they'll buy corporate bonds, they'll print money, they'll issue debt. They don't care. What will the reaction be at the next crisis? But over the last 50, 60 years, it seems that these problems are solved by central banks. Debt problems are solved by issuing more debt. Why would it crash this time? Why would the reaction not be that again?
It could be. We could have hyperinflation. And I think the next thing, it can't be QE. It'd have to be mailing checks to everybody. That's
helicopter money. Yeah.
And actual checks to the people's, you get $1,000 or $2,000 or $5,000 check in the mail. So you have to go out and spend it. To me, that's really the only option. They don't have the QE option really. But, we have to go back and look at history. The long-term capital management, which was the hedge fund that went under with about gold, the banks came in and bailed out the hedge fund.
Right.
And then in 2008, we had the Fed and the central banks bail out the banks. Now the thing is, and several analysts have said this, who is going to bail out the central banks?
Right.
Now they can print money. They can do a lot of things. And I'm not talking about something that's going to end in a week or a month or a year. When I look at the energy, it's going to take 5-10 years. But you see, it's forever. Each year we go on, the energy gets much worse. We only found 2.8 billion barrels of oil, conventional oil last year. We consumed 25 billion. And this year it's going to be even worse. And so that can't continue forever. So it's always the energy. While they can print money, they can't print energy. And even though they can put more debt to extract more high cost energy, if you see how much energy and what it takes now to produce one shale oil field, there's not. It's kind of like we used to print put $1 in debt to create $1 or $2 or $3 of GDP.
Right.
Now, from the last thing I know, it was $4 of debt to create $1 in GDP. Well, it gets to the point where the energy you can't pull the energy out of the ground anymore.
And that's happening in China too now. China led us out of the financial crisis by issuing debt, but getting a big bang for that buck in the 2009, 10, 11, 12 period. But now they're in the same position where they're not getting the return that they once were on issuing debt, and they're concerned now that they're not going to be able to pay back their debt through their state-owned enterprises that owe money to their state-owned banks. Before we close out here, Steve, I want to get your take on a couple of things going on, just your general impression of cryptocurrencies, and then also what's going on with advertising and Google and YouTube, censorship, and so on. So first, let's talk about your take on cryptocurrencies. Are they a safe haven? Is Bitcoin digital gold? Is there something there, or is that just a waste of energy too? And then talk to us about how you're involved in something involving advertising online.
Oh, yeah, the whole Bitcoin thing, that's another hour discussion. But to put it
we'll
in a nutshell...
We'll have you back on for that discussion as well. But just give us a quick take on your view on how cryptocurrencies fit into the overall scheme of things.
To put it in a brief synopsis, I would say that the cryptocurrencies are a typical bubble. And when you see Ethereum and Bitcoin and some of these cryptos go up 10% and down 10% in a day, I went back and looked at Amazon and Netflix, and those are some seriously insane stocks. Amazon, Netflix, the most it went up was 40% in a month. 40% in its best month, 40%. Amazon went up 22%. Ethereum just went up 105% in a month. And now, and that's just typical. Yes. But if you look at the crypto chart, I believe that Bitcoin and the cryptos took off at the end of towards the end of 2017, due to the massive exposure the cryptos were getting, especially on the mainstream media. And then we had the mainstream was it the Chicago Board of Trade? I'm trying to think of they were trading, they were shorting it now. It could be shorted on the exchanges. When that took place, that was the impetus to bring all the suckers in. And that's how I look at it. It brought in all the suckers. Now, my associate and I, we agree, or we think that the cryptos will never surpass their highs. But this time could be different for this bubble. It could be the first time they do surpass their bubble high, but we doubt it. And we will know that within the next 3 to 4 months. So even though blockchain offers interesting solutions, and I do hear that there are gold crypto-backed cryptocurrencies.
Yes.
I do believe they could be an interesting thing as well, but they're not going to trade like these crazy crypto prices. They're going to be more of a way to protect your gold in a crypto kind of format. I'm not saying I agree with it or disagree with it, but to me, I don't see them trading as crazy as these other ones. And I think there's a lot of fraud in the crypto market, Lewis, and we've seen it firsthand. There's a lot of, and if you look at there was an article in Zero Hedge that this one analyst that did the research says over 3 billion of the daily volume is inflated. And so when you start to see that, I think the whales are controlling the price of these things, and they go in and out of these different cryptos to push their prices up 15, 20, 25% in a day. It is the perfect indication of a bubble, and we'll know it's a classic bubble probably within the next 4 to 6 months.
All right. Now, what about advertising?
Well, I was a part of the commodity ad network, and my associate Peter Froelich started it, and I became the marketing person for it because we wanted to provide an alternative to the Google and the Facebook and Twitter, as well as YouTube. As you know, many YouTube websites have been defunded and banned due to what they call as fake news or news that they disagree with. Now, part of it was a decision because a lot of mainstream advertisers, they do not want that kind of material. And they're the ones that their ads are up there. So part of it is a business decision, but part of it is also Google's ideology of what they think is the correct information. Now, even though I don't agree with everything on the alternative media, I do believe they have the right to present that information. So we have the commodity ad network, and we have a group of about 40 websites, and we plan now to start working on an alternative media search engine. And so we hope that more, and unfortunately, we started this right at the time when the alt media took a nosedive.
In terms
not
of
only
traffic. Yes,
precious metal sales fell off a cliff, and not only precious metal sales. Prepping, survivalism, gun sales, which we don't advertise gun sales, but gun sales, ammo, all that took a nosedive.
And why do you think that was?
I think a lot of people were hoping that with Trump would offer, let's say, an alternative to the mainstream or the dark state. And in some ways, maybe he is. And so I think a lot of the alternative media, they view him as a hedge against the deep state. And so right now, the collapse or financial Armageddon or the need to prep or have bulk food doesn't seem to be such an issue now. Now, maybe if Hillary Clinton was elected president, it would be. But now, I think after Trump was elected, a lot of people aren't worried about protecting for financial collapse or financial issues. And so it's affected the whole alternative media market.
Makes sense. So, full disclosure, Smaulgld is also part of the Commodity Ad Network. I put the ads up there. I think it's a very great idea to have, if Google's making the monolithic decision that advertisers don't want to have their products served on these alternative media sites, but in a real market, if Google didn't have an ideological bias, they can easily allow through technology a advertiser to say, well, I don't want to be on InfoWars, or I do want to be on InfoWars because I'm selling this product and I want to reach people who are on InfoWars. I want to reach people who are Smaulgld subscribers, or I don't want to. But they basically decided, no, they don't want to deal with them whatsoever. So I think the commodity AdWords network is a good idea because obviously your advertisers do want to sell products from the 40 websites that you've signed up already.
Yeah, and it's even more than that too, because as you know, the Google uses they track everything. Everything is tracked, and this information, as we know, has been, especially with Facebook. Look what happened with Facebook. A lot of the information is being, and we believe in privacy. We believe in good old-fashioned privacy. That's why the network is designed not to track everything. Because I don't know about you, but let's say you're interested in an exercise piece of equipment, and you search it. Well, if you look at websites, all you're going to see now is that exercise equipment
following you around. Yes,
following you, and that's tracking.
Yeah.
And maybe it works, but I'll tell you what, a lot of people their ad blocking now has become a big issue. A lot of people are blocking ads now, not only because they're annoying, they're videos, they make noise, that they know they're being tracked. And so after I looked at that exercise equipment, the next day I was no longer interested, but I noticed for 2-3 weeks, almost a month, I continue to see those ads. So how many ads did I not see because of this model? So we have a different model. We're hoping to grow that model over time. Everything takes time, but we do believe that it's best to offer a more private ad network to allow so the alternative media can't lose its message, and that's the reason why we did it. We don't want to lose the alternative media message, and unfortunately, there seems to be an orchestrated effort to diminish that message.
That's true. Well, Steve, thank you very much for joining me today. Please tell our listeners where they can reach you online, and I'll put links below.
Yeah, they can. Sure. I have the SRS ROCCO.com. I put 2 to 3 articles out a week about precious metals, about energy, the mining industry, and gold and silver investment, the economy. And I also started doing my own videos on my YouTube channel at the beginning of the year. And what's funny about that is I'm supposed to be earning ad revenue, which I applied for in January, and now it's in May, and they're still backlogged for bringing on new YouTube channels. But anyhow, the YouTube channel, I put out about 1 video a week, and there's a lot of information about updates on the market, the metals, the energy. And so those are the 2 places they can find my work.
All right. Excellent. Thank you very much, Steve. And promise to come back. We need to talk a little bit more about some other topics we didn't get the full exposure on today. Well, thank you very much for joining me today on the Smaulgld Subscriber Sound Off series. Thank you very much, Steve.
Thank you very much too, Louis.